Canadian real estate. For years, it's been a national obsession, right? But underneath all the headlines about bidding wars and crazy high prices, there's this deep feeling of anxiety that's really taken hold. So in this explainer, we're going to dig into the data, try to cut through all the noise, and really understand the forces that built Canada's, well, pretty precarious housing market. I mean, this is the question, isn't it? It's on everyone's mind. How did we get here? To a place where the cost of a basic human need, shelter, seems totally disconnected from what people actually earn for a living. It just feels fundamentally broken. To figure out why, we first need to see just how wide that gap has actually become. Okay, so take a look at this. This chart tells an incredible story. Over on the right, you've got the United States. See how home prices and what people have left to spend have kind of moved together? Makes sense. But now look at Canada on the left. Around 2005, those two lines, prices and income, just shot off in completely different directions. It created this gap that one source literally called comically large. And that's not just a small difference, you guys. That is a fundamental break from our closest economic neighbor. And this number? This just hammers home how wild that divergence is. Between 2005 and 2021, once you account for inflation, Canadian real home prices grew 13 times more than prices in the United States. Just let that sink in for a second. 13 times. So this tells us this isn't some global thing that's hitting every country the same way. No, something really unique has been going on right here in Canada. So to get to the bottom of that 13x mystery, we have to put on our detective hats. Because there are a ton of theories out there, right? Lots of simple answers for what is a very, very complex problem. So let's start by putting some of the usual suspects under the microscope. All right, let's jump into the explanations you hear all the time. The ones that come up at dinner parties or on the news. Are they the whole story? Or are they just convenient scapegoats for something much deeper, much more systemic? Okay, this is a big one. Whenever you hear housing bubble, your mind just immediately jumps to the 2008 financial crisis in the US. It's a really powerful comparison for sure, but is it actually an accurate one for Canada today? Well, the sources we're looking at suggest the answer is no. And the reasons why are baked right into the foundations of our financial system. So here's why it's different. Our system is just built to be more stable, or at least less prone to that kind of collapse. First off, Canadian mortgages are full recourse. In plain English, that means if you default on your loan, the bank can come after your other assets, not just the house. That's a massive deterrent to just walking away. In a lot of US states back then, mortgages were non-recourse, so you could, in theory, just mail the keys back to the bank with less personal risk. On top of that, here in Canada, our big banks hold almost all these loans themselves, which makes them way more cautious. In the US before the crash, loans were being bundled up and sold off like crazy, which spread the risk around and, encouraged some really reckless behavior. And now we get to one of the most debated, most emotionally charged questions in this whole discussion. Canada's welcoming historic numbers of newcomers. So it seems like simple supply and demand, doesn't it? More people, same number of houses, prices just have to go up. But is it really that simple? Well, the data suggests the effect is more proportional, not exponential. Research that looked at this exact question found that, on average, a 1% increase in population from immigration links up with about a 1% rise in housing prices. So yes, it's absolutely a factor, but the sources are pretty clear that it is far from the only or even the biggest reason for the massive price jumps we've seen. Blaming it all on immigration kind of lets the much bigger forces at play off the hook. Okay, so if it's not a 2008 rerun and it's not just immigration, what are the real systemic drivers? This is where we start to see how this problem has been woven into the very fabric of our national economy. This chart right here is so telling. Real estate, renting, leasing, that whole industry now makes up 13% of Canada's entire GDP. That is the single largest slice of our economic pie. It's bigger than manufacturing, it's bigger than oil and gas, it's bigger than finance. Our economy doesn't just have a big housing sector. In a lot of ways, our economy is the housing sector. And that has a massive, massive opportunity cost. When you look at where our investment money goes, this fascinating picture emerges. Here in Canada, we pour a huge amount of our capital into residential buildings. Meanwhile, down in the US, that money is more likely to go into things like research and development or information technology. So here's the key takeaway. Our national economic strategy, whether we meant to or not, has prioritized investing in housing over investing in innovation. We've basically chosen to bet on flipping houses instead of building the next big thing. And look, this didn't just happen by accident. It's been encouraged for decades by this mix of cultural ideals and government policy. We've culturally positioned homeownership as the ultimate sign of success, the Canadian dream. We've created programs like the Home Buyers Plan that literally tell you to raise your retirement savings for a down payment. And then at the local level, you've got restrictive zoning and not-in-my-backyardism that makes it incredibly hard to build anything other than sprawling, expensive single-family homes. So when you've got an asset that seems to only ever go up, an asset fueled by this belief that it can't possibly fall, and where the wealth of the people who already own one depends on new people buying in at even higher prices, well, it starts to make people feel pretty uneasy. And it leads them to use some very powerful analogies to describe that anxiety. This quote from a Reddit discussion about all this just perfectly captures that public feeling. The very term we use, the property ladder, implies that for you to move up, someone else has to take your spot on the rung below. It speaks to this sense that the system isn't really creating new wealth, it's just transferring it from the newcomers to those who are already inside. Now, that's a really strong term, pyramid scheme, so let's be super clear and just look at the textbook definition. The core of a pyramid scheme is that the returns for the early people are paid out using money from the newer people. So when you hear people voice this anxiety about our housing market, this is the dynamic they're pointing to, a system that feels like it needs a constant flow of new money and higher prices just to keep itself going. Whether the whole system is sustainable or not, there is an immediate and very real challenge dead ahead. Because years of super low interest rates are over, and a massive wave of homeowners is about to come face to face with that new reality. 60%. That's a staggering number. That's the share of all mortgages in Canada that are scheduled for renewal in 2025 and 2026. This isn't some small group of people. We're talking about a huge chunk of the market that is about to get a major shock to their monthly budget. And this table from the Bank of Canada shows us exactly what that shock looks like. For the huge number of Canadians with a standard 5-year fixed mortgage, they're looking at their payment jumping by an average of 15 to 20%. For some people with variable rate mortgages, that jump could be over 40%. That is a serious amount of money getting pulled out of household budgets, and it's going to have ripple effects across the entire economy. So is this it? Is this the moment the house of cards finally collapses? Well, the Bank of Canada suggests maybe not. They point out that a lot of people's incomes have gone up, and most borrowers were stress tested, meaning they had to prove they could afford a much higher rate than the one they actually got. There are also options, like extending the life of your mortgage to lower the payments. But, and this is a really big but, they're also clear that some people will absolutely struggle, and many, many more will be forced to cut back on other spending. So, what does it all mean? The most likely outcome probably isn't a dramatic 2008-style crash. Instead, the expert consensus seems to be pointing toward a long, drawn-out period of economic strain, a slow deflation of the bubble. Think financial stress, less spending, and stagnant growth. So not a sudden bang, but more of a long, painful whimper. And all of this brings us back to the fundamental question at the very heart of this entire crisis. Over the past couple of decades, we've transformed the idea of a home from simply being a place to live into the primary way for people to build wealth. We've incentivized it, we've financed it, we've built a massive part of our economy on it. The question now is, what happens when the Canadian dream as an investment comes into direct conflict with the basic human need for a place to live? And can we even have both?